From the morning reading, broad markets churn on light volume ahead of Friday's job report before the open. 7 of 10 sectors moved higher and one was unchanged on Thursday. XLB, XLK, and XLRE were the strongest sectors, while XLV was the weakest sector. Oil futures rose 86 cents to close at 50.56. Breadth weakened compared to the prior session as decliners led 1664 to 1342 on the New York Stock Exchange and led 1691 to 1094 on the Nasdaq. On the S&P 500 snapshot, again treading water before the jobs Friday. Futures were pointed lower at 8:30 a.m. when the morning's weekly jobless claims report was released. Despite a stronger than forecast report, the S&P 500 opened lower and sold off to its negative 0.44% intraday low about 90 minutes into the session. The index then bounced back above Wednesday close level and spent the afternoon in a narrow trading area between its 0.15% intraday high and the flat line. The session ended just a few ticks above the flat line with a tiny 0.05% gain in advance of the morning monthly employment report. The yield on the 10-year note closed up 3 basis points at 1.75%, the highest closing yield since June the 2nd. Gold is the latest defensive market to fall into a downtrend. After being above its long-term trend for most of the year, gold has closed below its 200-day average. The last time it did so, after a long time trading at above average prices, it ushered in a protracted bear market. It also lost value for the 8th straight trading day, one day shy of an all-time record dating back 40 years. Funded investors continue to retreat. According to Lipper data, mutual and exchange traded funds lost more than $9 billion in assets in the last week. But there is a seasonal influence to fund flows, and the first week of October has often seen a big outflow. Taking that into account, there is still a negative pull. It just wasn't nearly as pronounced. Silver has become the most hated ETF. Among the funds that are followed, the Optimism Index on the Silver Fund has averaged 6 over the past 3 days. In its history, the 3-day average has been this low only 4 other times. Once in 2008, another in 2008, 2011, and another date in 2011. Silver rallied over the next 1 to 2 days each time, but then also set a lower low in the days ahead. Longer-term measures for follow are still far from showing pessimism, as not that long ago there were overly optimistic levels. More than $500 million has left the most popular REIT ETF in the past week. During this bull market, that ranks as the 6th largest outflow in VNQ. Of the others, 4 of 5 coincided with bottoming action in the fund, so that's a modest positive. At the other end of the spectrum, high-yield bonds, HYG, and gold miners, GDX, continue to show the largest inflows. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:05 a.m. Mountain Time, and I am recording this in preparation for the market day of October the 7th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and dive into our morning report. And at the time of this cut, all 4 broad market indices were down just a little bit, between scratch and 0.25%. Same is true for all 4. Crude oil also down just below scratch. Euro up just above scratch. Bonds down just below scratch, and gold up about 0.33%. All this is being heavily influenced by the monthly employment report that'll be released in about 25 minutes. We'll start to see more significant action out of that, and that'll probably take place, of course, prior to the actual cash open. I still don't show on my data stream that China markets are open, so that's blacked out. It seems like it's been all week. I'm not sure what the story is over there, but that's what my data says. Hong Kong is down 0.4%. Japan's down about 0.25%. Germany's down about 0.4%. United Kingdom, the only one that's positive at 0.8%. In terms of macroeconomic reports for today, of significance in the United States, obviously you've got the employment report, which will be out an hour before the market open. You have also a whole bunch of FOMC members speaking at various points of the trading day and at the end of the trading day. You have Fisher, Mester, and George all speaking today. In terms of current market conditions, things continue to be relatively benign. You know, at times in the recent days, it's often seemed a little scary, but when you really boil it down, you know, short-term VIX is an 11.47. People are, and institutions are not buying a lot of protection. There's not a lot of fear being priced into this market. Skew is a 120. Anything below a 125 is considered benign. IV percentiles in the S&P and the others are also exceptionally low. The S&P at a 21, the Russell at a 9, single digits there, NASDAQ at a 19, and Dow at a 23. And for the fourth trading session in a row, not a single standard deviation size move has been put in on any of the four broad market indices. Now, that contrasts with the week prior, in which virtually every session seemed to have a standard deviation size move and often going in contrary directions one day to another. Part of that may be, you know, as we got into the end of this week, waiting for that monthly employment report. That is a very big deal and one of the biggest report releases of the month. In terms of the charts, let's see here. Here's the S&P futures. We'll dial it into the most recent action. And you see we're right up into the nose of the apex now on this symmetrical triangle. We've been talking about this repeatedly in recent days. And we get about one or two more candles. We're going to have to either break down this pattern and say that it has failed, or we're going to get a breakout. So one or two things without repeating things that were said in the last day or two. The fact that this was bullish going into the pattern, the expectation would be slightly to the bullish side here, but that's very much neutralized in many ways by the fact that we're in the middle of the pattern in the cloud, a very, very neutral kind of stance. So we've had little partial fake breakouts intraday on the top side and the bottom side in recent days, but summarily rejected on both sides. So the bulls and bears are about as finely balanced as you can get at this point. And we'll have to see who actually is able to pull off the win. It is also very much the same thing in the Dow. Very, very neutral, very, very finely balanced. NASDAQ has been up against horizontal resistance, and the Russell also up against some overhead resistance and very much in a sideways consolidation pattern. Again, both the Russell and the NASDAQ do have the benefit of being above the cloud, so a bit more bullish in their bias. And when you put all that together, the four charts would tell us the expectation is for a breakout to the bull side. But obviously, as new news comes into the market, that could have a great influence. And as much volatility as we had last week, and as this chop has gone back and forth, I mean, it'd be terribly easy to see a breakdown just as easily as it would be to see a break up. And that new news with the employment report, that's a big enough report to be the trigger, to be able to go either direction. The other alternative for today is that people are somewhat confused or unsettled or not really clear as to which direction to go. And you could see false breakouts to both sides today of this triangle and then ultimately end up with some sort of indecision and sideways candlestick and pattern continuing on. So it does not have to break one way or another. We could continue with sideways consolidation. So be prepared for that potential as well. Crude oil, of course, has clearly broken out of its recent pattern and up above the swing high. Give back a little bit last night, but basically is trading with a small body right now. This could easily go either way as the broad market goes, as goes the employment report, etc. On gold, of course, gold has been breaking down. You heard one of the morning authors talking about gold and silver, and you know, pretty significant move there. And this has been related to the dollar, and you see the dollar continues to break out of its recent consolidation pattern. The other thing related to this that could be influencing the dollar this morning is the pound has truly broken down and is extremely choppy action in the overnight. So things happening with currencies for sure, especially with the British pound at this point. With respect to the bonds, you see bonds continue to show some weakness, 5-6 sessions in a row now, and coming back to test this prior swing low. So bonds seem to have decidedly converted from being into a long and intermediate term bull market, and of recent those patterns have started to fail significantly with the expectation of higher interest rates coming from the Fed. In terms of volatility, volatility continues to be relatively neutral, relatively benign, in the lower range of normal, and we consider that to be 12 to 15, kind of normal bull market type range for volatility. So obviously that, much like the broad markets, could break out of a pattern at any time if we should get enough news to give us the energy to make a real move. And that's probably enough on the charts for this morning. Most of the stories there, of course, were just basically sideways. And in terms of our daily report, much of this is also reflecting this kind of sideways chop. In terms of the market phase opinion, still market phase 4 up against resistance is the primary pattern. We have come close to having a break of diagonal support a time or two in recent days, but that hasn't actually happened yet. So we continue with market phase 4 until one or the other does happen. In terms of the three market timing signals, the first one from IBD confirmed uptrend, bullish. The second one, GMI index, did fall a notch to a 4 out of 6, but still a buy signal in place since 9/22. The decision point, of course, this one is more specific. It's broken out by index. It's broken out by 3 different time frames, and we have seen these signals, especially on the short term, just flip-flopping back and forth, back and forth. You've got to read this as finely balanced, and frankly a balance to in terms of not really achieving anything on the bull or the bear side and chopping back and forth in the consolidation pattern, but you also have to read this as an expectation of more chop to come. This is a long way from the stack of common signals that we like to see. In the short term, very mixed. In the intermediate term, somewhat mixed. And in the long term, very, very mixed. So overall consensus here, much as with the charts, is I would say to the bull side in a bias, and yet at the same time, not an expectation of any kind of significant moves either side until something triggers that event. The position sizing opinions, both models still coming in at 100%. Intermediate term market posture also flipping back and forth right now, back to a first day again. Strong bull signal. So you see the S&P back to a 56.1 on the positive slope. So this is really got to call this finely balanced neutral again. So don't make too much of strong bulls or weak bear signals on the intermediate term market posture indicator at this point until we get some sort of consistency and the start of a real move. Hedge warning status remains 0 plus. I've toyed a couple times in this week as to whether it should go to level 1, but in all cases we failed to actually break down through those diagonal support levels and have a close or anything like that. So we retain this current risk level in the market. If there is such a thing as a 0 plus plus, you could perhaps be there. Certainly I have my antenna sensitized, my radar screen is dialed in. I'm thinking that this could at any day break into an increased risk level, but it hasn't yet. So we're left with that. Option income strategies, VIX is still inside the acceptable window to initiate new positions. Cover call strategies put selling both in relatively conservative positions at this point. And as we've been talking about both from market timing signals and from chart patterns, you could see why you would want to be rather conservative and defensive at this time. Now, from the individual warning areas, you can see, frankly, very, very little red, and that's part of the reason why I've never gone to a level 1. Fairly benign in all these areas. We still have a relatively high distribution day count, though it's been falling. This was up as high as an 8 this week, and it fell to 7 and now 6. If it falls below 5, that will go back to a relatively benign level. Also trend area, nothing particularly concerning there other than, frankly, this one should have been in red. New York Stock Exchange new highs, new lows yesterday. The lows were more than 300. In terms of the key intermarket risk aversion indicators, all 5 of those charts were on the risk on status, so again benign. Sentiment also very, very neutral, nothing really terribly exciting in terms of the sentiment from a scary standpoint. And you see the fear and greed index also very, very neutral. And recent sessions we've gone 49 to 53. In terms of sector specific, again we see the higher beta, more risk on oriented, largely dominating the top of the performance charts, though a bit more mixed than we've had in some recent sessions. The stubs, the consumer staples, the telecom, utilities, the long bonds have been a bit more negative, but also seen a bit more balanced action. And nobody was terribly negative yesterday. Healthcare at the worst sector at a negative 0.38%. So that's where we are with that. In terms of sector percent change and market postures, you can see perhaps firming up a bit more to the bullish side on all 3 time frames. We have, most of these sectors, I should say a majority of these sectors, are now green signals on all 3 time frames, with the exceptions being generally the conservatives, the telecom, consumer staples, utilities, all coming from that conservative group. And overall performance for the week, still quite mixed, and for the month, still, with a slight bias to the negative. So we continue to have difficulty in really kind of achieving anything out of this market. A lot of chop back and forth being seen across all these different kinds of indicators. Okay, and let's go ahead and one thing I wanted to mention here is if you'd like to be able to get emails from Falcon Global, just go to this website, scroll down just a bit, you'll see this button here. And I don't share those emails with anybody. I've been asked to by other trade marketing organizations, but I do not share my email addresses with anybody. What you'll get is a very limited number of emails. Sometimes I'll send out an email to give you an alert, a heads up, in case you don't watch the YouTube channel every single day, that the hedge risk level has changed. Also periodic blog articles and other items of interest. But basically what it's going to ask you for is your name and your email address. That will also give you a hyperlink to a copy of my ebook about portfolio strategy. You might find that of interest as well. So very easy to get into that. Also, if you have a smartphone, if you're one of them, You can text Falcon Global, all one word, to this number 22828, and that will also get you into the email distribution list from Falcon Global. So a couple different options there. And let's go ahead and roll out to the disclaimers. So disclaimers, as always, hit the pause button if you need more time to review the disclaimers. Also, note the hyperlink down here at the bottom for the full set of disclosures. Manage that risk, and you should find that things become much more consistent. In the meantime, we'll be back with the next market preview from Falcon Global with Monday's trading session. Good trading, and have a great weekend.